Hello everyone, my name is Naledi. I am your tutor, and for today's lesson we will be looking at the elimination of intragroup transaction. Now, I'm basically going to do two of the most common intergroup transaction, and that is inventory and property, plant, and equipment. So remember, what we always eliminate is the profit. The reason for this is because when we consolidate, we take 100% subsidiary and 100% parent. So we are supposed to take them at their cost of fair value, remember, with the measurement principle. So any excess profit will then need to be eliminated. Now, the most important thing you must remember is that we use cost of sales to eliminate profit for purposes of intergroup transaction relating to inventory. That's why we debit the cost of sales. Essentially, what we are doing is we are eliminating profit and not necessarily cost of sales. We're just using cost of sales as a journal entry. So then we will debit cost of sales, credit inventory in the first year when we are selling inventory to each other, and then we will then do the deferred tax calculation. Now the deferred tax calculation always follows the main entry. This is how I always know my deferred tax calculation. Like in this case, if you are debiting an item that goes to profit or loss, that means you will debit deferred tax. And if you are crediting an item that goes to statement of financial position, that means you will credit income tax. So essentially it's like the opposite, because deferred tax goes to the statement of financial position and income tax goes to the statement of profit or loss. So you do the opposite of what you did in the main entry in terms of profit or loss and statement of financial position. And then in the second year, what happens is that all the profit that a company makes will be accumulated to retained earnings, including those that relate to the intergroup transaction. That's why we first have to eliminate retained earnings by debiting it, because in the separate financial statement it was credited. And then we also debit deferred tax, and then we credit cost of sales. So essentially what happens is that in the second year, there's always an assumption that the inventory was sold to a third party, meaning that now the company can eventually realize the profit. Now they can actually have the profit credited, meaning now they have the profit because they're sold to an external party. So you will have that entry where you say you debit inventory and then you credit cost of sales, and then you debit income tax, and then you credit deferred tax. Now, with the intergroup transaction where we have an item of property, plant, and equipment, in the first year you eliminate the entire profit, right? So you will say profit from the disposal of an asset, debit it, and then you credit the asset. And then you have to do an entire deferred tax calculation based on that. So you will say debit deferred tax because we debited profit from the disposal, and then you credit income tax, and then you realize the profit over the remaining useful life of the asset, meaning that you recognize the gain over the remaining useful life of the asset. And now you recognize it via depreciation. So that's why you see depreciation being credited. It's essentially what's being credited is profit and not depreciation. So you will take the total profit divided by the useful life of the asset, which in this case is 10 years, and then in the following year you will then the remaining profit will obviously go to retained earnings, like I explained with the income, with the inventory, and then you debit deferred tax, you debit accumulated depreciation, you credit equipment, and then again you realize the profit. You realize the profit over the 10 years. If you need more information on this, please contact me, and I will gladly help. Thank you.